Hello and welcome to Decision Time. I'm Karen Cho. Markets are pricing in. Jack Meaning joins us, Chief UK Economist at Barclays. Jack, we are waiting for this decision in a matter of minutes. We're expecting the interest rate to be cut to 3.75%, so much anticipation of a move today. What are your expectations?
Yeah, I think it would be a really big surprise, Karen, if we didn't see it from here. I think the market's been positioned for it for quite a while, and we didn't really get any pushback from MPC members in the lead up. So I think it will still be relatively finely balanced. I think a 5-4 vote is probably the most likely. Governor Bailey, again, is the swing voter.
To that point around who does what and who votes for what today, that seems to be quite crucial for market positioning. Gilts sterling, for instance, could move if we get a 6-3 cut. If another member, rather than just Andrew Bailey, who was anticipated to swing behind the dissenters last time, that held steady. Do you think that we could see some movement in sterling gilts if it's a 6-3 vote?
I mean, look, the gilt market's going to be really sensitive to any signals about policy from here, given that this meeting is pretty well anticipated. I think the interesting thing will be either something like a 6-3, given the inflation print we had yesterday, or potentially some of the more dovish members giving a vote for a 50 basis point cut, which would be, again, a similar signal.
We've had a lot of data to wade through in recent weeks, and the suggestion really is that we do have some strains on the economy. We had a budget that is also incredibly punishing. What is your view on the inflation story from here, as the number came through lower than expected this week, 3.2%?
It did, and there was downside surprise to us in terms of our modelling, but actually this story that inflation will come down relatively quickly over the next few months, it's been a large part of our thesis at Barclays for at least a year or so. So we're expecting inflation to drop below 2% by Q2 next year. And I think what we've seen in the most recent prints is kind of validating that view.
The comments from Andrew Bailey last time for not cutting, an excuse to hold out for the time being, was that he stressed although inflation had fallen a long way from its peak, it was still above the 2% target, could prove persistent, especially in services, food and energy prices. Do you think much has really changed in a month?
I mean, we've seen food prices come off relatively sharply. So I think, given they put weight on that, that is a big kind of area of difference between their forecast and, say, our own. Actually, the fact that food prices are decelerating along with the rest of the basket is probably quite telling for them. But going forwards, we have to kind of think of policy in a forward-looking sense. So if they wait until they're at 2% headline inflation, they've probably waited too long. And therefore, I think that actually this flow of data now is just giving them more courage of their convictions that they're on the right path and they should act a little bit preemptively.
So we are coming up to the decision, 20 seconds left as we count down to what we're likely to see. But it feels as though the growth rate too is going to be somewhat of a challenge, right? Keeping growth intact. Yeah,
when you look at all the high frequency kind of metrics, they're suggesting there was this slowdown through the final quarter of the year. So I think we'll expect that to carry on in the next few weeks.
Well, Jack, let's take a look at the decision as we take a quick look at that rate decision now. We've got the actual rate dropping 3.75%. So we do have a rate reduction as anticipated, the 25 basis points. Those voting for a cut, 5. Those voting for rates to remain unchanged, that is a 4. So the 5-4, not the 6-3 it could have been. In terms of market reaction, sterling dollar 133.72, 73 roughly. We are fairly stable still on the session at this point, and we might show you the yield reaction as well in just a moment as well. In terms of some of the commentary that we've seen now from the Bank of England, we still think rates are on a gradual downward path. That, according to Andrew Bailey, who has switched to vote for a rate cut. Bailey saying, but with every cut, how much further we go becomes a closer call. The staff forecast for zero growth in the fourth quarter for GDP. November forecast was for 0.3% a quarter on quarter. So that forecast now for zero growth, that flat outcome for the final stretch of the year. Underlying growth around 0.2% quarter on quarter. Inflation, according to the Bank of England, now expected to fall back towards target more quickly in the near term. That was something on the back of the budget that had been discussed about the implications for changes to energy and the fuel tax. So the budget likely to cut inflation in April 2026 by around 0.5 percentage point. We'd actually heard that in commentary recently. The budget likely to expected to ease in the first quarter of 2026. Inflation to ease in 2026 in the first quarter to around 3%, closer to 2% in the second quarter. And when it comes to the budget, likely to push inflation by around 0.1 to 0.2 percentage points in 2027-28. So the outlying years as well to be impacted. The BOE saying expect inflation to rise temporarily in December 2025 due to tobacco duty and airfares. And the budget could increase GDP by around 0.1 to 0.2% over the couple of years. Fiscal tightening to weigh after the 3-year horizon. The MPC judging around further policy easing will become a closer call. So again, finely balanced on what happens from here when it comes to interest rates on the basis of current evidence. The bank rate is likely to continue on a gradual downward path. The restrictiveness of monetary policy has fallen as the bank rate has reduced. Let's come back to Jack Meaning in reaction to what we've just heard today. What's your view? You did call the 5-4 split, Andrew Bailey, the swing vote here, but the rest of the commentary, anything jumping out to you?
Yeah, I mean, I think there's quite a lot in there actually for a meeting where, the decision was relatively well known in advance. I think that balance of those comments that you just read out, where they said the direction of travel is still gradually downwards, but they then kind of tempered that by saying, but the bar is going to be higher to future cuts. I think that's a pretty kind of expected line, and is something that suggests that actually we will see cuts, but maybe not many more from here. We think so probably we're close. Do you think? Yeah, I think that's probably what they were trying to deliver, a hawkish cut, and it sounds like they've kind of walked that line. The downgrade of growth in Q4, we would completely agree with that. I think it's quite hard to get anywhere near the 0.3 they had before. And so, downgrading growth, downgrading inflation, they have to acknowledge that there are probably more cuts coming, but they're keeping their options open.
What do you make to that downgrade to growth? Because some of the evidence recently suggested that the economy just went on hold, a big fat pause ahead of the budget as employers were waiting it out in terms of hiring, in terms of contracts as well across the economy. Does some of that start to fade out now that we've had some more budget certainty?
I mean, so one of the great bits of resource we have at Barclays is access to Barclays card spending data, which is like 40% of the card spending market. That showed this really kind of sharp kind of weighing on consumer spending through to the last week of November. And then it bounced back. And a bit of that might be Black Friday, a bit of that might be people starting to get a bit more confident. So we'll continue to track that as we move through the year, but that's certainly initially that tentative sign that something bounced back in the final month of the year.
I just want to get to inflation, and the line here from the BOE is data on inflation persistence, generally encouraging continue to be risked in both directions. But we did see the update here on the assessment around the budget and what that could do to inflation. And we heard from Lombardelli as well, one of the hawks over at the BOE recently, talking about that 0.5% impact that inflation could have on the economy thanks to changes around the fuel duty and other measures, rail as well. What do you think the inflation picture looks like as they talk about both sides of the equation here? Do you think there's any heat that could come back into the inflation price?
I mean, I think, what we're seeing is that near term, those kind of budget measures will mechanically just lower inflation. I guess the question for the BOE is really what does that do in the medium term? And there is an argument to say that actually if near term inflation comes down sharply, inflation expectations will also readjust and stabilise around the bank's target, and that will mean that medium-term inflation stays more anchored. I think if we see that, that will give some comfort to the hawks. The risk is that actually if we then start to see some inflationary pressures in the medium term, which you kind of referenced in some of those comments, then maybe they're a little bit more hesitant to do
In terms of market reaction, the 10-year gilt yield has risen 2.5 basis points to 4.5% after this. So just a little bit of movement. Home builder stocks are raising gains after this move today as well. The very interest rate sensitive part of the market that is telling you that investors are not really pricing in any more extreme moves from the Bank of England. When it comes to the next outing, as they talk about this now meeting by meeting approach almost, it sounds like quite similar to the ECB, doesn't it? Very cautious about what comes next. When do you think the most likely time frame will be a further rate reduction from here?
So I think February is probably too soon. I think they will only have one more cycle of data going into that February meeting, and as they've said, the bar is now higher. They want to slow the pace maybe of kind of cuts as they approach neutral, which is very ECB, as you say. So I think the most likely is March in terms of the end of Q1 next year. They'll have had 3 more rounds of data. They'll have a much more confident kind of view of where inflation's going. But that still means that they've got options either to go a little bit early if they need to, or to hold on a little bit more if they're still not confident by that meeting.
Jack, thank you for helping me out and reading between the tea leaves of what's just been produced from the MPC over at the Bank of England. Jack Meaning with us, Chief UK Economist at Barclays. Coming up on Decision Time, the monetary policy action continues. I'll be joined by Norway and Sweden's central bank governors right after the break. You're watching Decision Time. Well, Norway's central bank kept rates on hold at 4%, and a move widely expected by markets, but flagged it expects to loosen policy in the coming year if the economy ticks along as anticipated. And joining us now is Ida Woldenbacher, who is the governor of Deutsche Bank. Thank you so much for joining us today, Governor. Let me ask you about this decision. You still appear to be in inflation fighting mode, and this line in particular, we will finish the job and ensure that inflation is brought all the way back to 2%. What is taking so long to tame inflation?
Well, inflation has been stubborn around 3% for close to a year now. Imported inflation has come down significantly, but domestic inflation is still proving to be persistent, partly reflecting high wage growth and large increases in firms' costs over the past few years. But we do anticipate inflation to come down gradually, but we still think there is a need for a restrictive monetary policy stance.
When it comes to the decision today, do you just want to unpick that for us? How finely balanced was it at all?
So the outlook for the interest rate is little changed since our previous monetary policy report in September. But there were factors contributing on both sides. On the one hand, we had seen a weakening of the currency since our last report. That pulls in the direction of higher inflation and therefore also a higher interest rate path. On the other hand, we've seen some signs of weaker developments in the real economy, in labor, in unemployment and growth. That pulls in the opposite direction. And on the upside also, we have seen an uptick, of course, in international interest rate expectations.
I want to pick up on that point around krona. I was surprised that it was wedged into the document today because you flagged the depreciation since the September report. But if you take stock of how the currency has moved so far this year, the wild moves really contained around January to July. So why was that even a factor? And could these conditions persist and be a factor into 2026?
So we are forecasting a stable exchange rate going forward, and that's usually how we make forecasts for the exchange rate in our monetary policy report. Now, obviously, the currency fluctuates. The krona depreciated quite significantly in the spring of 2023, but since then has moved more sideways. But it matters for our inflation outlook. So the fact that the krona has been weaker than anticipated pulls in the direction of a higher inflation forecast, and therefore also pulls up the interest rate path.
The message for the pathway from here is that you're not in a hurry to reduce rates. 1 to 2 cuts next year. What could impact the pace or the acceleration or any delay in some rate reductions from here?
Now, obviously, we monitor closely indications of continued high growth in firms' costs. We see wage growth coming in this year likely higher than anticipated, although we do expect wage growth to come down further next year. But obviously also the currency, if that continues to weaken or is weaker than anticipated, that could also lead to inflation remaining more stubborn above target, which would call for a higher interest rate than envisaged in the past today.
When it comes to some of the weakness, though, the labour market has been fascinating, not just in Norway, but also elsewhere. Your statement today was talking about the unemployment rate has increased somewhat. We know that there's been a little bit of a cool wind across some of the economies when it comes to employment. Are you worried about the trajectory on job losses from here?
No, so our outlook is for unemployment to remain fairly stable, and our registered unemployment is now close to the level it was pre-pandemic, and our outlook is for a stable development going forward. But we have seen some signs of a weakness during the autumn, which is also why we've revised downward our estimates of capacity utilization and revised downwards our estimates of growth this year and next. But we continue to see a moderate upturn in the Norwegian economy, with inflation staying broadly stable.
I'm curious about the youth unemployment issue, though, because that's where you're seeing some cracks emerging in economies, and Norway is the same here, the highest level in 5 years when it comes to youth unemployment. Are you concerned that there's an AI adoption story causing some sort of structural change in the employment market? Is that something that central bankers need to be watchful of from here?
I think that's certainly something we need to be watchful of. I don't think we're seeing that in the Norwegian data as yet. We've seen an uptick in unemployment among the younger groups, but those are at least to some extent part-time jobs. There are students, and we're not seeing that as evidence of any widespread AI displacement as yet. But obviously that's something we need to watch for going forward.
Governor, thank you so much for joining us today on the back of the decision. Ida Woldenbacher with us, the Governor of Norges Bank. Elsewhere, Sweden's central bank held rates steady at 1.75% as widely expected. In terms of the path ahead, the Riksbank said there would likely be no change in policy through 2026 if the outlook for inflation and growth holds. Erik Thedin joins us now, Governor of Riksbank. Governor, thank you very much for joining us today. Let me ask you about the decision. The market was anticipating a hold here, but do you want to give us some colour around the decision making?
No, I think we are in as my colleague in the ECB says, we're in a fairly good place. We have growth picking up, already started to pick up. We're actually revising our forecast for this year, 2025, from 0.9 to 1.5%. So we saw growth picking up this second half of 25, and we see further growth coming in 26. So we're forecasting a growth of slightly below 3%. So that's pretty solid. And at the same time, we see inflation coming from slightly elevated numbers in the beginning, in middle of this year, to 2%. If you exclude some of the VAT changes next year. So, you know, growth coming up, inflation stable, that's a pretty good kind of environment. And then again, that's the forecast, but so that's the reason why we stay on hold at this time.
To that point around what happens next, there are some ifs dangling there out in the marketplace around the guidance, hinging on inflation, also hinging.
No, so we have this kind of straight line, 1.75% for the next 3 or even 4 quarters. And I think that is basically saying that's a balanced risk. We, of course, don't say it's going to be certain that we have 1.75%. On the upside, I think we have a strong growth. It could be even stronger. Some of the private forecasters actually think it could be even stronger than 3%. If that happens together with some, let's say, disturbances in the supply side, either domestic kind of issues or global issues when it comes to supply, that of course could cause inflation to come up. On the other hand, we could also have further weakening of the consumption, and maybe the outlook is not as good as we think. Together with stronger krona and other forces that have kind of brought down inflation, that might be stronger than we think, and in that case we would have, let's say, a too low inflation going forward. So there is, I would say, a balanced risk. Then it's always these tail scenarios. That's why we're talking about the geopolitical risk, which is to some extent actually another word for the awful war in Ukraine, and the potential kind of effects on the economy coming from that, but also of course the uncertainty around economic policy, mainly coming out of the US.
To that point, Governor, I spoke to your finance minister at length over the course of this year about the tariff impact and the compensating factor for the fiscal policy here, as the government has unleashed some tax cuts and increased spending to the tune of 1.2% of GDP, trying to shield the economy. Do you think that you're mostly through the tariff impact now?
Very hard to say. The tariff impact should be fairly limited on, our economy, I think. The main negative effects will come for the country that actually imposes the tariff, i.e. the US. And we have, of course, as you know, seen a little bit of an uptick in inflation coming out of that. But apparently there's so many other forces and influences to an economy. It's very hard to say that exactly what's coming from tariffs or not. If you look on the export industry in Sweden and the industry at large, that has actually been fairly robust during this last couple of fairly negative years. So I think, our industrial sector have been coping fairly okay with, let's say, the overall fairly negative environment, also including the tariffs.
Governor, I was talking at length with the governor too of Norway about the impact of the labour market from some of the various factors, from the macro, the uncertainty we've been talking about, from the geopolitics, but also the AI effect. What do you think you're witnessing there in the economy as to whether the AI adoption story might be causing those structural problems in your economy too? Do you see that going into 2026?
So you couldn't exclude that. When we have the elected business surveys and other surveys made, it doesn't seem to be a major effect. What we've seen is actually slightly higher unemployment of the more well-educated young people, and that might be an indication of some AI effect. But having said that, I think it's so far very limited, and I think the increase to the fairly weak labor market also, again, among the more well-educated is more, I think, a reflection of now 2-3 years with very low growth and a weak economy, and eventually that affects the labor market, and that's actually what we also seen. Although we are expecting a slight improvement of the labor market from now on until and during the course of 26 and 27.
Governor, I want to get to the playbook for interest rates from here. I feel like I need to get the binoculars out there to have a look at what could take place. Fourth quarter 2027 is the expectation for another reduction, then fourth quarter 2028. How reliable are some of these outlier forecasts when we've just seen in 2025 so many outside events can sway the economic factors?
Now you said reduction. I think our interest rate path is actually an increase in the interest rate. But anyway, so yes, I think that's why we focus on the next coming 3 quarters, because there we think we have some kind of value to put forward the interest rate path, some kind of policy content in it, if you like. Beyond that, it's very much something that comes out of a typical macro model, which basically says that if economy is growing above trend, eventually you come to more constraints when it comes to resources, and then you need to dampen the activity slightly with higher rates. But very uncertain. So I totally buy your argument here that I think the best guess is that will not be exactly as our rate path says, especially in the longer term. But this is the best judgment we have at this time.
My apologies on that. Third central bank I've been talking about, yes, but of course 1.94% in the fourth quarter is the level we're talking about in 2027 when it comes to those rates. I want to just ask you what we're seeing too down the track when it comes to the krona, because this has been fascinating. The Swedish krona, the best performing currency in the G10 this year. How is the renaissance of the currency impacting monetary policy? And do you think this strength, this resilience will stick around next year?
So the strengthening of the krona has been very welcome. We had the krona very weak when we at the same time had high inflation of also other reasons. And that, of course, added to that negative inflation outlook. So that was something that was a negative thing for the economy, negative for monetary policy, and was with some frustration we saw the krona being very weak when we tried to bring down inflation. Now the krona has been substantially stronger, mainly though should say vis-a-vis the dollar, but also to the euro. So I think it's really welcome. It's welcome from an inflation point of view. That will basically lead to everything being equal, slightly lower rates, because we don't have the inflation effect. We actually have some deflation effect, I would say, from the krona. And still, what I hear anyway from corporates is there's not really a big kind of negative impact on the general corporate activity, which is of course also important. So the krona has been helpful, but having a forecast is very hard. We think it's going to continue to strengthen a little bit. Well, that's the forecast we have had for a long time, but nothing dramatic. So I think we're much closer to some kind of reasonable level of the krona. And I think if you should find some fundamental reason, I think the overall economic balance with fiscal side being fine, inflation being fine, growth picking up. Actually, a more liquid bond market as well, as we have made our QT. All of that adds to a sentiment which seemed to be kind of working in the direction of a stronger krona.
To that point, let me ask you about what happens externally, because the dollar krona trade here is also reliant on what the US Federal Reserve will do. And there's been, as we know, a lot of forces at play here, some of it coming from the White House as to whether we could see a more dovish tilt to the Fed next year. How closely are you watching those factors?
No, being a small, mid-sized central bank in Europe, you follow everything that comes from the largest economy in the world very, very closely. But it's we don't have any inside information, of course, of this, so we need to just follow what happens. I think it's very important for us and for I think the global monetary system that we have a strong, credible Federal Reserve Bank. I think that's a foundation, and we have had that for so many years. So I hope that will continue. If there were lower rates, you could argue that could have some influence on the dollar. On the other hand, that's probably also expected, so it's not a given. But again, I think the krona is very much the flip side of the dollar coin, right? So if the dollar weakens, we're going to strengthen. So in that sense, of course, the dollar move will be extremely important also for us to follow. But maybe the relation to the euro is more. It's easier to track that has something direct to do with, let's say, Swedish fundamentals, because we don't have that kind of big interest differentials or big difference in policy vis-a-vis the euro as we have vis-a-vis the dollar.
Governor, good intel there, good way of thinking about it. Thank you so much for joining us today and describing the decision to us and some of the variables here. Erik Thedéen with us, the Governor of Riksbank. There's plenty more central bank action to come on CNBC from 1 p.m. London time. We'll bring you coverage of the ECB's decision, and you can watch Christine Lagarde's press conference in full from 1:45 p.m. London time on the CNBC International Live YouTube page.